Have you ever wondered what keeps the heart of the global economy beating? We often imagine it as a colossal, unbreakable machine, a testament to human ingenuity and ambition. But what if I told you that this mighty heart, this intricate web of finance that connects us all, is far more fragile than we think? What if a single, almost silent number, ticking upwards in a distant land, could threaten to stop the flow of its lifeblood, sending shudders through the entire system? That number, seemingly obscure yet profoundly powerful, is the yield on 30-year Japanese government bonds. For years, it was a symbol of stability, a quiet anchor in a turbulent world. But recently it surged, climbing to a level around 3.41%, a figure once considered unimaginable, a ghost from a forgotten economic era. This isn't just a flicker on a trader's screen. It's the sound of a foundational pillar of the modern financial world beginning to crack. To understand the gravity of this moment, to see why this single number holds the power to reshape our economic future, we must journey back in time, back to the moment the story truly began. Our story starts in the early 1990s, in a Japan that was reeling. The nation had just experienced the bursting of one of history's most spectacular asset bubbles. The soaring heights of Tokyo's real estate market and the dizzying climb of the Nikkei stock index had come crashing down, leaving behind a landscape of economic ruin. It was the beginning of what would be known as the lost decades, a prolonged winter of recession, deflation, and national soul-searching. In this desperate struggle against economic frostbite, the Bank of Japan BOJ made a decision that would not only define its own destiny, but also profoundly alter the course of the global economy. They embarked on an unprecedented journey, a radical experiment to resuscitate their nation's heart. With a determination born of crisis, the BOJ pushed interest rates down to near zero, and eventually into negative territory. They opened the floodgates, injecting massive amounts of money into the system. They became a buyer of last resort, purchasing government bonds, stocks, and other assets on a colossal scale, all in an effort to anchor the system and fight the paralyzing grip of deflation. This wasn't just a policy, it was a lifeline. And in doing so, Japan unwittingly transformed itself into something new, something the world had never seen before, a global money pump, endless well of cheap capital. From this well, a torrent of money began to flow. With the cost of borrowing yen reduced to virtually nothing, global investors, hedge funds, and financial institutions saw an opportunity of a lifetime. They borrowed yen by the trillions, a financial maneuver that became known as the yen carry trade. They then converted this cheap yen into US dollars, euros, and other currencies, and poured it into every corner of the globe. This capital, born from Japan's struggle, became the fuel for a worldwide boom. It flowed into American real estate, pushing up home prices from California to New York. It powered the rise of European stock markets, funded corporate buyouts, and financed ambitious infrastructure projects. It surged into the dynamic, high-growth emerging markets of Southeast Asia, creating new fortunes and new skylines. For 3 decades, Japan, while fighting its own demons at home, became the quiet, unassuming benefactor of global prosperity. Its cheap money, the invisible hand-lifting asset prices everywhere. But every river eventually meets the sea, and every long journey has an end. The recent, sharp rise in Japan's 30-year bond yield signals a monumental shift in this global current. The yield on a bond is, in essence, the cost of borrowing. As it climbs, the fundamental premise of the entire system, the ability to borrow yen for next to nothing, begins to crumble. The cheap money well is running dry. Borrow cheap in Japan, invest everywhere else model, which has been a cornerstone of global finance for a generation, is breaking down. And as it does, the consequences are beginning to ripple outwards with terrifying speed and force. The vast pools of capital that Japan's policies pumped into the world are now at risk of being sucked back. This isn't a gentle ebbing of the tide. It is the sudden closing of a 30-year-old dam and the violent reversal of the water's flow. Imagine the immense pressure this creates. Investors who borrowed yen now face higher costs to maintain those loans. To pay off their mounting debts, they are forced to sell the very assets they've bought with that borrowed money. A great unwinding has begun. The markets that benefited most from Japan's generosity could now face the most pain. We could see a wave of selling wash over U.S. stocks, which have reached dizzying heights on the back of easy credit. European markets, real estate across the developed world, and the once booming stock exchanges of Asia could all experience a severe contraction as this capital retreats. Heading back home to Japan to settle its accounts. This is the sound of the global money pump switching into reverse. The difficult truth is that Japan can no longer sustain its role as the world's provider of cheap capital. The nation, after its long and arduous journey, now finds itself shouldering three immense burdens, each one straining its ability to continue its old policies. The first is a mountain of public debt, a legacy of its decades-long fight against deflation. With government debt exceeding 230% of its GDP, Japan is one of the most indebted nations on Earth. As its own bond yields rise, the cost of servicing this colossal debt becomes an ever heavier weight. Every 0.5% increase in interest rates could add tens of billions of dollars to its annual interest payments, diverting funds from essential services and investments. It is a debt trap that is slowly closing. The second burden is the twin specter of inflation and a weakening yen. For years, Japan fought to create inflation. Now, like the rest of the world, it is struggling to contain it. A weak yen, while once seen as a boon for exporters, has pushed up the cost of imported energy and food, squeezing households and businesses. The BOJ is caught in an impossible bind. Raising rates to strengthen the yen and fight inflation would make its debt burden unbearable. But keeping rates low risks further currency depreciation and economic instability. Finally, the world has changed. The third burden is the harsh reality of a more dangerous and uncertain geopolitical landscape. The need to increase defense spending in response to regional tensions puts yet another strain on the nation's finances. Japan can no longer afford to be the world's quiet banker. It must now look inward, shore up its own defenses, and confront its own economic vulnerabilities. The era of sacrificing its own stability for the sake of global liquidity is drawing to a necessary and painful close. And so, the entire global financial system, a system that has become profoundly dependent on the steady, predictable flow of cheap capital from Japan, is shaking at its very foundations. The tremors are not confined to the major economic centers. The great financial capitals of New York, London, and Tokyo will undoubtedly feel the strain, but the aftershocks will travel far and wide. Emerging countries, like those in Southeast Asia, including Vietnam, are now exposed to powerful undercurrents that threaten to pull their economies off course. Stock markets, real estate sectors, and currency values, all of which have been buoyed by foreign investment, are now at risk. The cost of borrowing is rising for everyone, everywhere. The tide that lifted all boats is now receding, and we are about to see who has been swimming naked. What we are witnessing is not a temporary market correction, not a fleeting moment of volatility that will soon pass. It is the end of an epoch. It is the beginning of a new era, a fundamental rewriting of the rules that have governed our world for a generation. We are moving from a world where money was abundant and cheap to a world where capital is scarce and expensive. Liquidity, the very oxygen of the financial markets, is becoming tighter. In this new, harsher environment, every asset from stocks and bonds to real estate and cryptocurrencies is being reevaluated. Its true value retested in the crucible of higher interest rates. The journey of the last 30 years, a journey defined by Japan's struggle and the world's reliance on its solution, has reached its destination. We are now standing at the threshold of a new, uncertain, and far more challenging path. This is the great repricing, and it has only just begun.